Hello, guys. Plug Power, trading under the ticker symbol PLUG, has once again captured the attention of both institutional investors and retail traders alike. As of the latest trading session, the stock is hovering around 3.26 per share, marking a sharp 3.97% intraday decline. While at first glance, this could easily be dismissed as just another volatile day for a company that has long been known for its sharp price swings, the current downturn tells a deeper story. One that extends beyond surface-level market movements and into the core dynamics of investor sentiment and financial positioning. This decline isn't the result of random market noise or broad sell-offs across the energy sector. Instead, it appears to be tied to substantial activity in the options market, where an unusual surge in near-term put options has been recorded. These instruments, which increase in value as a stock's price falls, are being heavily traded by larger market participants. The surge suggests that sophisticated investors are either actively betting against Plug Power's short-term prospects or are attempting to hedge existing long positions in anticipation of further downside risk. In either case, the implication is clear. Confidence in an immediate rebound remains limited, and the market's near-term expectations have become distinctly defensive. For years, Plug Power has represented the promise of a hydrogen-powered future, a bold vision where clean, renewable hydrogen would play a central role in the global energy transition. The company positioned itself as an integrated leader, aiming to control every step of the hydrogen ecosystem, from production to distribution, and ultimately, to consumption through its proprietary fuel cell systems. In theory, Plug Power could become the one-stop solution for a trillion-dollar green energy industry. However, the reality reflected in today's trading action paints a much more complex and challenging picture. The stock's slide from an opening price of $3.38 down to an intraday low of $3.15 reflects the market's growing impatience with the company's prolonged inability to translate vision into profitability. Investors who once focused on where Plug Power could be by 2040 are now far more concerned about how it plans to make it through 2026 without resorting to another round of heavy shareholder dilution. The pattern of today's trading offers insight into this evolving narrative. The stock opened slightly lower, then experienced a sharp drop within the first hour of trading, a movement typically associated with institutional selling. The bounce from the $3.15 level suggests that retail investors and smaller funds continue to see value at these depressed prices, hoping for a turnaround. Yet, the failure to recover back to its opening price indicates that selling pressure from larger players remains dominant. What's unfolding here is a quiet tug-of-war between long-term believers and short-term skeptics, taking place against the backdrop of a broader market growing increasingly risk-averse. The macroeconomic environment adds another layer of difficulty. Elevated interest rates have placed tremendous strain on capital-intensive companies across the clean energy sector. Plug Power's business model, reliant on large upfront investments for building hydrogen plants, manufacturing electrolyzers, and expanding infrastructure, has become significantly more expensive to sustain. Each new project now requires financing at rates not seen in over a decade, eroding the company's already thin financial flexibility. In essence, the rising cost of capital is directly undermining the very foundation of Plug Power's growth strategy. This brings us to a critical, but often underappreciated factor in the company's current predicament: short interest. Plug Power has become one of the most heavily shorted names in the renewable energy space, with over 20% of its public float reportedly sold short. To put that in perspective, for every 5 tradable shares, 1 is currently being used to bet against the company. The short thesis is not built on rumor or speculation. It is grounded in the company's financial track record, which has consistently featured negative cash flow, operating losses, and repeated capital raises that dilute existing shareholders. Critics argue that Plug Power's long-term projections remain disconnected from its near-term execution, with profitability targets continuously pushed further into the future. As the company issues more shares to fund its expansion, each new round of financing weakens shareholder value and delays the potential for positive cash flow. This cycle has created fertile ground for short sellers who view the company's current model as unsustainable without a dramatic turnaround. For retail investors attempting to understand this dynamic, it's essential to monitor metrics such as borrow fee rates, days-to-cover ratios, and short interest data, which can all be found on platforms like Finviz and Ortex. A rising cost to borrow shares signals intensifying bearish sentiment, while an elevated days-to-cover ratio indicates that any sudden rally could trigger a short squeeze. though such events are unpredictable and risky to chase. Rather than dismissing bearish activity as manipulation, investors should study it as a form of critical feedback from the market, reflecting legitimate concerns about financial health and execution risk. So, what exactly does Plug Power do, and why has its story become so polarizing? The company is a pioneer in hydrogen fuel cell technology, primarily serving logistics and material handling sectors. Its fuel cell systems are used as replacements for conventional lead-acid batteries in electric forklifts, with major clients including Amazon, Walmart, and other large-scale warehouse operators. This segment remains Plug Power's core business and a steady source of revenue. Yet the company's long-term growth strategy extends far beyond forklifts. Plug Power aims to build a comprehensive hydrogen infrastructure across North America, including green hydrogen production plants in states like Georgia and New York. These facilities use electrolysis powered by renewable energy to produce hydrogen, which can then be supplied to industrial and transportation customers. This vertical integration model is ambitious and visionary, but it comes with staggering costs. Building and scaling this network has led to an alarming cash burn rate, as reflected in recent earnings reports, and the promised future profitability remains elusive. The company's challenge now is credibility. Investors have heard the story of exponential growth before, only to see timelines shift and losses deepen. The market sentiment has evolved into a prove-it mentality, no longer willing to reward lofty promises without tangible financial results. Looking forward, Plug Power's path remains fraught with both opportunity and risk. On the optimistic side, government incentives could provide a much-needed financial lifeline. The Inflation Reduction Act, IRA, offers up to $3 per kilogram in tax credits for clean hydrogen production. For Plug Power, securing favorable interpretations of these credits is not just beneficial, it's existential. A positive ruling from the U.S. Treasury could drastically reshape the company's economics, improving margins and possibly reigniting investor optimism. Additionally, new large-scale contracts outside the material handling sector, for example, in stationary power generation or heavy-duty transport, could serve as powerful catalysts. But even more critical than new deals is the company's ability to execute, getting its plants operational, scaling production efficiently, and showing consistent improvement in gross margins. Achieving these milestones would do more to rebuild confidence than any marketing campaign or headline announcement. However, the downside risks remain just as significant. The most pressing threat is financial sustainability. If the current rate of cash burn continues without a commensurate rise in revenue from high-margin products, Plug Power will almost certainly face another round of capital raising. That means further dilution for shareholders and potentially lower share prices. Any delays in plant construction or missed production targets could also trigger severe market reactions, given the fragile state of investor trust. The competitive landscape is another growing concern. Industrial gas giants such as Air Products, Linde, and emerging renewable energy players are all accelerating their own hydrogen initiatives. While Plug Power once held a first-mover advantage, that lead is narrowing as better capitalized companies enter the field with deeper pockets and more diversified portfolios. Layered on top of these challenges is the broader macroeconomic environment. If interest rates remain elevated into 2026 and beyond, the entire clean energy sector could face continued valuation pressure. Growth stocks dependent on future profitability, like Plug Power, suffer disproportionately when the cost of borrowing remains high. The upcoming quarters will be pivotal. Analysts and investors alike are watching one metric more closely than any other: gross margins. For years, Plug Power's margins have remained in the red. A sustained move toward positive territory would signal that the company's model is beginning to work, that its operations are maturing, and that it may finally be moving toward self-sufficiency. Without this progress, however, even the most optimistic projections will begin to lose credibility. In summary, the current moment for Plug Power represents a crossroads. On one side lies the ambitious dream of becoming a global hydrogen powerhouse. On the other stands a harsh financial reality that continues to challenge its survival. The 3.97% decline we've seen today is more than a statistic. It's a reflection of the tension between vision and execution, between hope and hard data. Investors must now look beyond hype cycles and social media chatter. The company's fate will not be decided by Reddit discussions or bullish tweets, but by its ability to deliver measurable progress in revenue growth, margin improvement, and cash flow management. Plug Power's long-term potential remains significant. The hydrogen vision is far from dead, but the financial runway is shortening rapidly. The next few quarters will determine whether Plug Power becomes a cornerstone of the clean energy revolution or another cautionary tale of overpromised innovation. Until then, the market remains watchful, skeptical, and, above all, demanding results. The information presented in this video is for educational and informational purposes only. Nothing in this content should be interpreted as financial, investment, or trading advice. The opinions expressed are based on publicly available data and personal analysis, and they may not reflect the most current market conditions. Investing in the stock market involves significant risk, including the potential loss of your entire investment. Always perform your own due diligence or consult with a licensed financial advisor before making any investment decisions. The creator of this content is not affiliated with Plug Power or any financial institution, and no compensation has been received for mentioning any company or stock in this video. By watching this video, you acknowledge that you are solely responsible for your own financial decisions.